Hello everyone, and thanks for joining us for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner. I'll be your host for the next half hour as we talk about all the issues related to your money. How to make it, how to keep it, and hopefully how to help it grow. Let me start off by giving you a rundown of what we're going to be covering on today's show. First off, we're going to be talking about a little bit about the active versus passive debate on Wall Street. Now, this is a debate on Wall Street that's as old as the hills, whether it makes sense to pay a mutual fund manager to manage stocks and bonds in an attempt to beat the market, or whether that is actually worth any money to you. So interesting new study came out, and I want to share you with the results suggesting that maybe it's not worth paying those managers to do what they're doing. So we're going to talk a little bit about that. We're also going to be joined by our mortgage money pro, none other than Steve Tetzner with Homestar Mortgage. We're going to be talking about something that candidly I don't know a whole lot about, so I'm looking forward to this conversation. We're going to be talking about private mortgage insurance. What is it? What does it cover? Do you actually need it? How much does it cost? All of those details. So we look forward to that conversation. We're also going to be talking about some changes that are coming up for money market mutual funds. So if you have a money market fund in a brokerage account, in a 401k, in a variety of different places, there's some changes coming up, and you may already seen some of those changes in anticipation of new SEC regulations. So we'll talk about that and what you can expect. And finally, we have a viewer question on how to use 529 plan money. Always a hot topic here on the Money Pros. So that's everything we're going to be talking about. But let's lead off with this conversation about the active versus passive debate. Now, there's a debate that's been going on Wall Street, and the sides don't change much. But the debate is this. Is it worth paying managers to try to beat the market? So what do we mean by paying managers? So when you buy a mutual fund, you're essentially hiring a man, a woman, or a team of people to select securities. Now, it might be stocks, might be bonds, might be a combination of those things, might be real estate. There's a whole variety of things that can be inside of a mutual fund. And generally what you're hoping is that manager or team of managers is going to do better than a passive benchmark. In other words, do better than a passive collection of those same securities. So the idea is this person or team of people is going to be able to outsmart the market. The problem is that there's a lot of data that suggests that managers are not consistently able to do this, if they're even able to do it all. And the problem that presents further is that you pay for that privilege. So you are paying, and the question is, are you getting what you're paying for? So let me throw up a slide and we'll continue this conversation, because this information comes to us from Standard & Poor's, Dow Jones, and of course they are a company that is in the business of creating passive benchmarks. So these are the benchmarks that managers track their performance against, and active managers are trying to outperform these benchmarks. But in a recent study from S&P, their latest data suggested that in the large cap stock universe, 84%, over 84% of active managers failed to beat the large cap benchmark. In the mid cap benchmark category, 76, nearly 77% of active managers failed to beat the mid-cap benchmark. And finally, in the small cap category, over 90% of active managers failed to beat their benchmark. So what are we talking about here? What's a benchmark? A benchmark is a passive collection of securities in a particular category. So when we take, for example, that small cap category, and we're talking about how small cap managers do, we can simply take a collection of small cap stocks. We call that a benchmark. We measure how that does. Anybody can buy a passive collection of securities. It doesn't require any particular talent, and it's very cheap and easy to do. The active manager is trying to cherry pick the individual securities in an effort to outperform that benchmark. And according to that data we looked at in the small cap category, 90% of active managers failed to even beat the passive benchmark. And the same thing went for mid cap and large cap categories. The problem is you're paying extra for these active managers to try to beat their markets. So when you're paying, that fee is actually further reducing your performance. So potentially, not only is the active manager getting less return than the benchmark that they're competing against, but they're being further hindered by the extra fees. That's the reason we often talk about on this show using index funds, using passive investments like exchange-traded funds, where you're essentially just capturing the passive benchmark performance and you're not paying for the privilege of trying to do better, something that often doesn't happen. So that's a little bit about the passive versus active debate and some interesting new information that's out. All right, up next is our mortgage pro, Steve Tetzner with Homestar Mortgage. We're going to be talking private mortgage insurance. Stay with us. We'll be right back. Welcome back to the Money Pros. I'm joined now by our mortgage pro, Steve Tetzner with Homestar Mortgage. Steve, good to have you back. How's it going?
Doing great, thanks.
We're going to be talking about mortgage insurance today's segment, but we always like when we have you on to get an update on what's going on in the mortgage markets right now with rates and activity and things like that. And we always like to give the disclaimer, this show's being taped a couple of weeks in advance, so
right.
Anything can happen on a daily basis in the mortgage market, so we need to make sure we let the viewers know that. But as of right now, where we're sitting, first of all, how is the real estate market in Rhode Island, so southeastern Massachusetts, the area you deal in, and then let's talk a little bit about interest rates.
Yeah, extremely robust. The market is still overwhelmingly a seller's market. Southeast and well into Massachusetts, it's extremely busy, extremely competitive market if you're a buyer. We've talked about this, I think, last show about people who are trying to make bids, and if you're trying to make the purchase subject to the sale of your home and your house isn't sold, it's just not going through. So it's a very competitive market.
And what are you seeing with interest rates? I mean, we've had you on the show for years, and we've been talking about how low interest rates are. It's a recurring theme, how low interest rates are, and that they're going to go up at some point, and we think it's going to be soon. What's going on right now?
They're still staying low.
It's really amazing.
If you were to ask me a year ago where rates would be today, I would have told you close to 4%. We're seeing 30-year money still down around 3 3/8. 20-year money is close to 3%, and 15-year money is like 2 5/8, 2 3/4. No points on purchase transactions. So obviously, people with excellent credit, down payments, etc. But that's still cheap money.
And as we work our way farther and farther away from the financial crisis of 2008, is it becoming a little bit easier for borrowers to borrow, or is it still first-class credit all the way? And
well, it was never really first-class credit all the way. There are programs out there that do allow for people that have had some bumps in the road, but you can't have severely bad credit, and you have to have some down payment money if you do. The non-conforming products still do not exist. So the products that are out there are fair, but the documentation requirements and the regulations are just becoming increasingly worse.
So let's jump into our topic du jour, which I professed at the opening of the show. You and I were talking about it a little bit offline, and you said, let's talk about mortgage insurance. I don't know anything about it. He said, well, that's the perfect topic then, and I think you're probably right. Now, I referenced it as private mortgage insurance because that's kind of how I think about it. I think about the acronym PMI, but maybe that's not the right way to talk about it. What are we talking about when we're talking about mortgage insurance? And it's not necessarily private mortgage insurance.
That's correct. So mortgage insurance is insurance basically for the lender, the investor. So whether it be Fannie Mae, Ginnie Mae, Freddie Mac, or could be an individual lending institution, where an insurance company is sharing the risk of default of the loan. So if the consumer goes into foreclosure situation, a percentage of that loss will be covered by this insurance. So there are different types of insurance. There's the PMI, the private mortgage insurance, which everybody refers to, which is on your conventional, that's your Fannie Mae, Freddie Mac, or jumbo type of scenarios. But then you also have mutual mortgage insurance, which is more of a government pool. It's a Ginnie Mae pool where you're talking about like an FHA loan, where an FHA loan has an upfront mortgage insurance premium, and then they have a monthly premium. And all of this goes into a pool, and so that when a consumer does default, that money is in that insurance pool to help cover the loss or cover a percentage of the loss to the investor.
So I feel like some people may get confused. I think I've probably even gotten confused on this from time to time. The idea that the mortgage insurance is somehow designed to protect the borrower. It's not as if, if I lose my job or, die, that it's going to pay off my loan or something like that. That type of insurance exists, I guess, but that's not what we're talking about here.
That's correct. You can purchase insurance, for job loss. Things like that do exist, but no, that is not what mortgage insurance does. Mortgage insurance simply facilitates a buyer to be able to purchase a home or someone to refinance a home that doesn't have 20% equity in the property. If you have 20% equity in the property, you typically are not going to need mortgage insurance. So if you're putting a 20% down payment, or if you're refinancing and you have 20% equity, then mortgage insurance is typically not going to be required. What mortgage insurance simply does is it allows the people who don't have that equity or that money to be able to actually obtain a loan.
Because if the private mortgage insurance, or excuse me, the mortgage insurance didn't exist, the lender wouldn't be interested. There would just be too much exposure, essentially.
It would either be, correct, there'd be a 20% down situation, or there'd be an extreme increase to the rate, so that the lender could self-insure the loan.
So the insurance, and I always try to think about insurance in terms of who it's trying to protect exactly, is really protecting the lender, because the borrower, in order for the policy to pay out, they have to be foreclosed on. So they're going to lose their property. They're out of it essentially. Correct. At that point anyway. So if it's really protecting the lender, who's paying the premiums here?
The borrower.
Okay.
Yep.
So you're really paying so that you can get the loan, essentially.
That's correct.
So you referenced who might need it and who might not, but let's make sure we clarify that not everybody needs it. What's the cutoff between needing it and not needing it?
Typically 20%.
Okay.
Unless you're doing certain types of government loans, like an FHA loan. Even if you needed an FHA loan, let's say that because of credit situation or something that the FHA program would allow that a conventional wouldn't, even if you put 20% down with that program, you still have to have some type of mortgage insurance.
And how is the premium determined? I mean, I imagine it's based on the size of the loan, or are there other factors involved?
Yep. It's not typically the size of the loan unless you're talking about a jumbo, which mortgage insurance in the jumbo category doesn't really typically exist in the market. Private mortgage insurance is determined by your down payment. So the larger the down payment, the lower the premium, okay, and your credit score. So if you're a 760 credit score and you're putting 5% down versus a person who has a 680 credit score putting 5% down, the person with the higher credit score is going to pay lower mortgage insurance.
And we talked about the fact that it's protecting the lender, but the borrower is paying for it. Who gets to choose what insurer is used? Is it the decision of the lender or the borrower?
Yeah, it's the lender. The borrower has no choice whatsoever, and it's really irrelevant because if you look at the mortgage insurance rates from one company to another, they're essentially identical.
So it's not a matter of needing to shop around or trying to get the best deal or anything like that?
No, they're typically the same. It's all regulated, so the mortgage insurance companies have to have their rates approved by the individual state's insurance division.
So I'm envisioning potentially situations where initially to purchase a house, because you don't have a big enough down payment, you're required to get private mortgage insurance, or mortgage insurance. But as you live in the home over a series of years and you pay more and more off on the mortgage, and potentially the value of the home rises as well, your equity increases. Is there an opportunity to get rid of that expense?
There is, but it's becoming increasingly more difficult. So
Really?
if you're paying the loan on term and you were scheduled to drop the PMI in, let's say, 4 years or 5 years, typically the federal regulation says that when you're below 80% loan to value, you have that more than 20% equity, you have the opportunity to drop the PMI. What we're seeing now is the investors are more apprehensive because they got burned back in the 2004, 2005 arena when property values were increasing significantly. And people would buy a house and 2 years later, they were making their regularly scheduled payments, but because of the market conditions, they had enough equity to drop the PMI. So they would petition, pay for an appraisal on the property, and then drop the mortgage insurance. Then when all the property values dropped, the mortgage insurance was gone, all that shared risk for the mortgage insurance companies, for the lenders, was gone, and that's how they lost all their money. So they're being a lot more cautious now. So when people are doing it, they're requiring typically the person to have some type of valuation assessment done to make sure that the equity position is strong before they'll allow them to do that.
So I just learned something. I was under the impression that if you got the loan with private mortgage insurance, that was going to be with you for the life of the loan regardless of your equity, but there is language in the loan that provides for the dropping of it potentially.
Well, it's a federal regulation.
So you don't have to refinance the loan.
Not necessarily, but certain types of loans, like government loans, if you look at a USDA loan or an FHA loan, with an FHA loan, if you put less than 10% down when you initially buy the property, that monthly mortgage insurance, although it declines each year, stays on the loan for life of loan. So certain types of loans do have life of loan mortgage insurance.
And you'd have to refinance to another type of loan in order to get rid of it.
Correct.
Last question I have for you, is it, we're spending all this time talking about it, is it particularly expensive? I mean, what are you finding it's adding? Can you talk about what it adds typically to a monthly payment, a range, or?
Well, it really depends, again, on the down payment and the type of loan and the FICO score. So it's not a set premium, it's a percentage, it's a factor. Okay. So, if it's a $200,000 loan versus a $100,000 loan at the same factor, the mortgage insurance is going to be more on the $200,000 loan. The factors are, a massive grid that we just went through a big change on the private mortgage insurance side about 2 months ago now, where every 20 points in your credit score is a different factor. So 680 to 699 is one insurance premium, 700 to 719 is another. So that they're really looking at the risk grade. The higher the credit score, the lower the mortgage insurance.
Okay.
With a government loan, the down payment can affect it a little bit, the type of loan. A lot of people say, oh, well, I want to get a VA loan because there's no mortgage insurance. There's no monthly mortgage insurance, but they have what's called a funding fee, which could be anywhere from 1% to 3-4% of the loan amount. So all loans out there really have some type of insurance if you're not putting 20% down with good credit.
Well, I know a little bit more about it than when I started, but I think there's probably a lot more to go. Thank you for that explanation. Great having you here. All right, when we come back, we're going to be talking about changes to money market funds. Stay with us, there's still more to come. Welcome back to the Money Pros. Now we want to talk about some changes upcoming, and potentially you may have already seen these changes occur with money market mutual funds. So you could have a money market fund typically in a brokerage account, an IRA. You could even have it in a 401k plan. And the nice thing about a money market fund is people consider it a safe place to stash cash. Unlike other mutual fund share prices, which can fluctuate from day to day, money market mutual funds historically would be kept at $1 a share, so they're stable value. If you had money in a money market fund, the value of the fund would never go down. Now with interest rates as low as they've been over the past several years, the value of the fund would only go up a little bit, but it would certainly never go down. So it's always been considered a safe place to stash cash. The problem is that back in the financial crisis of 2008, some money market funds, due to instability in the cash credit market, had difficulty keeping their NAVs at $1. And this caused a significant amount of concern, as you can imagine, when it happened. So the SEC has recently come up with some new regulations that govern money market funds, and this is significantly impacting how brokerage firms and 401ks operate with respect to money funds. So here's the deal. If you have a money market fund, effective October 14th of 2016, the SEC is putting in effect new regulations related to how these funds can be priced. So we're going to put up a slide. We're going to talk about the changes briefly, and then we can talk about some of the impacts and things like that. The first thing is that most money market funds, the NAV is now going to be allowed to float. So remember when I talked about that $1 a share NAV as being typical for a money market fund, and that's what keeps your, when you put in $10,000, it makes sure that, you're confident that it's always going to be worth $10,000. It is possible that in certain market situations, money market NAVs could float below $1. So you have to be aware that now there's the potential for principal loss with certain money market mutual funds. Next thing is there could also be redemption suspensions. So this means that if you put your money in certain market conditions, the money market fund manager could restrict your ability to withdraw money from the fund to maintain the fund's liquidity. So that would, the amount of the redemption suspension could vary, whether you could only take out a certain percentage of the money or a certain period of time. There's a variety of different ways that could come down, but the new regulation allows money market funds to suspend redemptions. And then finally, they could also impose redemption fees. So they'll allow you to take your money, but perhaps if you take out $10,000, there's a 1% fee on that withdrawal. So those are the three, let's call them tools, that are being put in place by the SEC to help money market fund managers better manage their funds, particularly in times of market stress. So as a money market investor, you really have to keep this in mind. If you're putting money in a money market as a place for safekeeping, you want to be aware of this. Now, the other thing you want to be aware of is these changes do not affect government money market funds. Most brokerage firms, IRAs, many 401k plans will have options with a money market called a government money market fund. And these changes are not impacting government money markets. So those money market type funds continue to be the safe haven to keep your money. And in many cases, we've seen brokerage firms already switch their core accounts and many of their customers over to those government money market funds. So something you want to pay attention to. There's going to be more information on this, and we'll continue to keep you updated. Up next, a question on 529 plans. Stay with us. There's more to come here on the Money Pros. Welcome back to the Money Pros viewer question time. So let's throw this one up on the board. And this is a great question. I had to look this up, believe it or not. I don't know all the answers right off the top of my head. Viewer writes in, our last child has finished college and we still have some money left in a 529 plan we established for her. Can we use that money to help her pay off her student loans? Now, you know what? Any reasonable person would think, well, if I can use 529 plan money to pay for college tuition, I should be able to use 529 plan money to pay for loans that paid for college tuition. But in fact, you cannot do that. Loans are specifically restricted or prohibited from being paid by 529 plan money. So it really has to be tuition that money goes to. And unfortunately, if you have some loans left over, you're not going to be able to use that money unless you simply pull the money out of the plan, pay the taxes and the 10% penalty. So my best advice would be to either try to use the money yourself on furthering your education, or maybe if the child goes to graduate school or something like that, you'll be able to use those 529 plans. But unfortunately, you're not going to be able to do it to pay off the loan. If you've got a question for me, I hope you send me an email. You can email me, moneypros at foxprovidence.com. We get a lot of questions through our Facebook page. You can look for us on Facebook, Money Pros, and send us a message. But we love to hear from you, and I answer all our viewer questions, so be sure to hook us up. Thanks for watching. We'll be sure to see you again next time right here on the Money Pros. Have a great day.